Welcome to another video of Halal Pips. Today's video is on Forex terms to know. The Forex market is filled with unusual terms, acronyms, and terminologies that might leave us scratching our heads. When it comes to trading, unfamiliar terminology and a lack of knowledge may be a major roadblock to a trader's success. In this video, we'll go over a few key terms that every Forex trader should know in order to enhance their Forex trading skills. So, let's get started by defining what currency pair means. When choosing a currency to trade, you'll notice that it comes in pairs. A currency pair is a price quote of the exchange rate for two different currencies traded on the foreign exchange market. The base currency is the first listed currency in a currency pair, whereas the quote currency is the second listed currency. The first listed currency, or base currency, is purchased when a currency pair order is placed, while the second listed currency, or quote currency, is sold. There are three main groups of pairs. The 8 most common currency pairs are called major pairs that include USD as the base currency or counter currency. Any two major currencies that do not use the US dollar as the base or counter currency are referred to as cross pairs. Exotic pairs are less well-known currencies that can be extremely volatile in the market. Next term is leverage. Leverage in Forex trading refers to having control over a large amount of money in the market while only having a small amount of money in your account. Leverage is usually expressed as a ratio in trading, such as 150, 1 to 100, or 1 to 200. Leverage typically ranges from 1 to 1 to 1 to 400 at IFC markets. Let's look at an example. If you invest $1,000 with leverage of 1 to 100, you'll have $100,000 in your trading account. While leverage can increase potential profits, it can also increase potential losses, which is why the amount of leverage on your trading account should be carefully chosen. Now, let's talk about bid and ask. The terms bid and ask refer to the best possible price at which buyers and sellers are willing to transact in the marketplace. The price we pay to buy the pair is referred to as ask. On the other hand, the bid is the price at which a currency pair is sold on the Forex market. Let's take a look at the Euro-USD currency pair as an example. The current bid price is 1.0661. It means that you can sell €1 for 1.0661 US dollars. The ask price is 1.0664. It means that you can buy €1 for 1.0664 United States dollars. The difference between the bid and the ask is called the spread. This is the fee charged by a dealer to execute a transaction. Spreads will be wide if a market is very volatile but not very liquid, and vice versa. For example, major currency pairs, such as Euro-USD, will have a narrower spread than emerging market currency pairs, such as USD-ZAR. Now, let's understand what Pip and Pipettes are. The smallest increment that an exchange rate can move up or down is called a pip, which is short for percentage point. For example, if the Euro-USD rate rises from 1.1050 to 1.1051, that's 0.0001 United States dollars increase equals 1 pip. In most currency pairings, 1 pip represents a fourth decimal place movement, 0.0001. One exception is the USD-JPY currency pair, where a pip represents a change in the second decimal place, 0.01. There are Forex brokers who quote currency pairs to 5 and 3 inches decimal places, in addition to the standard 4 and 2 inches decimal places. They are quoting fractional pips, also called points or pipettes. For example, if the GBP/USD pair moves from 1.30542 to 1.30543, that's 0.00001 United States dollars increases 1 pipette. Next term is going long or short. You are either buying or selling a financial instrument when you make a trade. When trading assets, an investor can take either a long or a short position. In traditional trading, a long position is when you buy an asset with the expectation that its price will rise, allowing you to sell it for a profit later. When you make a short trade, you sell a borrowed asset in the hopes that its price will fall and you will be able to buy it back for a profit later. And finally, we will discuss bullish and bearish. The term bullish refers to a trader's expectation that the price will rise from its current level. Being bearish implies that you believe prices will fall from their current levels. Bullish and bearish can also be used to describe a current market trend or movement. For example, when the price is in an upward trend, it is called a bullish market. That's all for today. Stay tuned.
Thank you for watching with halalpips.com. Share your thoughts and ideas with us in the comment section.